Hi, and thanks for clicking on our YouTube. My name is Craig Basinger, and I'm the Chief Investment Officer at Richardson GMP. And the title of our presentation, one of our regular updates on our macro outlook for the market, is entitled Opening Up. Much of the content that is in this webcast or YouTube is available in our monthly investor strategy report. If you'd like to get a copy of that, email either myself or any member of the team, or contact your investment advisor. So let's jump to it. This is our disclaimer. It's as of July 7th, 2020. So what I want to talk about today, and I'll keep it brief. This will be about 10 to 15 minutes long, but a quick update on the markets. It certainly has been a very eventful first half to 2020. A little update on the coronavirus. The markets have clearly been demonstrating their immunity to the virus of late. A little bit of an economic update. We've seen a significant bounce off the bottom, and the bounce has certainly started on the recovery side. Its future path, of course, remains relatively uncertain and unknown, but we'll shed some light on our views in that area. And then also the markets. The markets have had an incredible second half and have healed a lot of the wounds that were inflicted during the first quarter of this year. And then finally, how we're positioning from an asset allocation perspective and how we believe investors should be positioning as we head into the third quarter of 2020. So there's no denying it. This was a very eventful first half. The market obviously started pretty much ignoring a pandemic, which then became the centerpiece of what's impacted the markets. We had a full-on bear market that was extremely quick, the quickest in history for most markets, measuring how quickly it fell from an all-time high well into correction and then bear market territory and then deep into bear market territory before starting to stage a very strong recovery in the second half. And just to give you an idea of how far things have moved, the TSX, had a high of 17, just under 18,000, reached a low just over 11,000, and now sit at about 15,500. So these are pretty big swings. S&P, similar path, 3,400 at the peak in February. The bottom in March was 2,200, and the recovery has brought us all the way back to 3,130. Now, obviously, it's been the global pandemic and the self-induced global recession that's been impacting markets considerably in both directions. And on the pandemic side, things are still getting worse in the US and in emerging markets. Other regions are doing much better, including a lot of areas in Europe that were epicenters of this pandemic before it really started to land in North America. The economic data, unprecedented how quickly things stopped. And again, that's because it was a self-induced recession. We turned a lot of the economy off. And the rebound off that bottom has been very strong, albeit there is a long way to go. Policy obviously has remained extremely supportive, and that's what's been helping the markets. But it's also been fund flows in both directions that have been driving things of late. And the fact is, the market, will parts of the pandemic get worse, especially in emerging markets, southern U.S. The market seems to push through this. It's been pushing through trade tensions. It's been pushing through civil unrest in the U.S. It's been pushing through the rise of Biden in the polls, which again, time will tell how that actually impacts markets. But this market has certainly proven very resilient in its recovery off the bottom. So a little bit on the coronavirus and sort of an update on that. There's no question. We started to see a lot of improvements globally back in sort of May as things gradually improved, but then they really spiked higher in June. And a lot of that spike came from, one, the U.S., not New York, but other areas, especially in the South, and also emerging markets. We're now at a point where almost 1% of the U.S. population has been confirmed to have COVID-19 at one point. And that is a big number, because of course the number is likely higher than that, but just almost 1% confirmed. To give you an idea of what's going on in emerging markets, it's even a little bit worse. South America has exploded in cases. Chile actually has 1.5% of its population now confirmed to have been infected with COVID-19 at one point. And Brazil has obviously seen staggering numbers as well, and that's what's been driving a lot of the rise. Now, this chart on the bottom left, it may look encouraging. Again, the purple line is the number of active cases. So again, that's your diagnosed to have a COVID-19 and still have it. In other words, you have not passed into the recovery or unfortunately the passing phase. That is still rising. Somewhat encouraging, the number of active cases has started to come down. But again, a lot of that is not because the number of new cases has slowed, but it's the fact is the number of recoveries has started to rise. And that's just because so many people have been infected that we're starting to get that way. The issue right now, we're seeing this, we saw this spike in June. The death rate is starting to pick up as well. And I think that's starting to weigh on a lot of the healthcare facilities and capacity. Now, it's not the same everywhere, and that's, this isn't, I don't even think this is the second wave. I think, the better way to think about this is a wave that started in China and has been gradually spreading around the world at different stages and at different speeds. It obviously hit Italy and Iran very quickly after China. It then hit New York City quite quickly, and it took a longer amount of time before it started to get to critical levels in southern U.S. states and emerging markets. Now we're at those stages. So it's really, it's almost like a ripple that's going through the entire population. And, Brazil, India, US, they're all up there with, having pretty aggressive increases in number of cases. The flip side, though, there's other areas that are doing much better. Italy is doing much better now. France is actually largely reopened and, no social distancing at a minimum, and things are getting back to normal very quickly. So not to celebrate that just yet, because you don't know where things are going, but it's quite impressive that some of these countries are actually largely back to where they were before and looking relatively, don't want to say immune, but having gotten through this. So we'll see how that plays out further down the road, but it is certainly encouraging. And I think one of the other aspects is our society learns very quickly. We as humans adapt quite quickly, and the fact is we're getting better at this. We're getting better at social distancing. We're getting better at controlling things. Not everywhere. A lot of it comes down to population density, testing, trace, that type of thing. But the fact is we are getting better at this. And also the market seems to be starting to get immune to COVID-19, and that's been going on for some time now. This chart on the bottom right essentially is the weekly change in cases, and then also the change in the equity markets on a week-to-week basis. And right now, everything's clustered on the left-hand side there. In other words, we're still seeing rising cases, sometimes markets up, sometimes down. It's not actually a very strong determinant factor. It was earlier on during this pandemic, but now the market has started to see through to the other side. Whether that proves correct or not, of course, only time will tell. So wow, this recession, and we've been saying this from the very beginning, this recession is very different than any other. There's no real epicenter. It actually impacted services much more than anything else. But the bounce off the bottom has been, much bigger than I think a lot of people expected. Very different than any other past recoveries. One of the reasons is there weren't any excesses. So we turned off big chunks of the economy with a light switch, and they're turning back on, maybe not quite as fast as a light switch, but pretty close. This is the Citigroup Economic Surprise Indices on the bottom left. The U.S. is now sitting at a level of 200. The number doesn't mean anything, but to put this into context, it has never been this high since this index was created back in the early 2000s. In other words, the data is really surprising where the consensus estimates are. And, I think that goes to tell you just how quickly, because we shut it off intentionally, how quickly it can come back as we ease some of the social distancing. But while it is a good bounce, this picture sort of explains how far we have to go. This is the total number of people employed going back to 2010, and how employed in the U.S. And the fact is, the U.S. lost over 20 million jobs. Yes, they have regained, 5, 6, 7 million, which is very impressive and very much bigger than people had expected. But it is still a long way to go. And the other problem is, some of the jobs will come back very quickly. I mean, your barbershops open up, those jobs are back, those people are there. Patios open up, hospitality's there. And to give you hospitality, the industry itself in the U.S., in February employed about 17.5 million people. That got down to about 8 million. In other words, that many jobs were lost in that one industry. And now it's back in a big way to about 12.5. However, the early job improvements are likely very quick to come. There's others that will be much slower. And that's because a lot of businesses will simply wait. They'll simply wait until they actually see end demand before they start to fill those positions. And we are seeing things getting back to normal. This is open table data, so as seated guests, Germany obviously leading the charge, give you some evidence of what's going on in Europe. The UK, which opened up their pubs, obviously spiking off the bottom. Canada, US, we're a little bit more wobbly. We're still more of a gradual recovery, but it is starting to gain momentum. Things are opening back up. Now, a lot of people have talked about what does this look like? Is it a V-shaped recovery? In other words, big recession, activity slows down, and a big rebound back up the other side. We think we're in the early phase of that V, and we don't think it's going to be a V. We think it's going to be more of a flipped radical, and we think we're in this stage where you do get this big bounce off the bottom. That's why we're seeing such great economic data. The next phases are going to be much harder to come by to get positive data because we won't be bouncing off such an exacerbated low level. And the fact is, estimates have come down, and they continue to come down as far as estimates for GDP in 2020. Yes, everybody's expecting a rebound in 2021. We would agree as well. But the damage being caused, there is real economic damage being caused. And I think we'll get the bounce off the bottom. But then, again, the rest of the recovery is going to probably be a lot slower. And that's why we view this recovery more as a flipped radical, where you have a big drop off, big bounce off the bottom, and then more of a gradual recovery at that point. And at some point, that's going to start. So the markets, the markets clearly have full mindset. There's no question about that. Equity markets, Canada, the US rose about 20% in Q2. Pretty phenomenal. And a lot of that was driven by, a couple different things. One, it was driven by the better economic data. Two, it was driven by the fact that even though cases are still rising in the US, there appears to be at this point limited appetite to go back to a strong lockdown mode. Yes, we'll probably increase social distancing. It'll be sort of 2 steps forward, 1 step back. The progress is encouraging, and even though it might not be the best thing from a health perspective, it is going to be good from an economic perspective. And central banks have been there big time, and they continue to be there big time with sort of providing this stability, providing liquidity, providing quantitative easing, providing fiscal, support to make sure, fewer people fall through the cracks, or fewer businesses fall through the cracks of this strange global recession. And even though the markets recovered quite a bit, let's not forget, markets not the economy. Never has been. They are correlated. They do follow each other longer term, but sometimes they do diverge considerably. And right now, it's been the non-economically sensitive portions of the market that are really moving. These are the gains for the S&P 500 and the TSX. S&P for Q2, S&P gained over 20%. 8% of that came from technology. 3% came from consumer discretionary, and that includes Amazon in that sector. So it's been a very narrow leadership, and most other sectors are really lagging. Canada, a little bit different. We've had a big boost on the information technology, Shopify, and also we've really been benefiting on the material side. And it's not all the materials; it's much more the golds. But nonetheless, the narrow leadership has certainly been evident. And there's also been this bit of a fear of missing out. Now, this chart on the right is ETF and fund equity flows on a weekly basis. It's a rolling number. But nonetheless, the last time we had big inflows into the equity markets from, let's just call this the retail investor, was in February of 2020, before everything started to turn really bad. Since that time, we've had net outflows across the board, except for one brief period late in mid-April. And, unfortunately, the market has recovered considerably, and a lot of investors, I think, have been sitting on the sidelines thinking they're not buying this recovery. And don't get me wrong, we're not buying it necessarily either, but we're just saying a lot of people have been sitting on the sidelines, which has sort of created this strange dynamic and this fear of missing out kind of mentality in the marketplace. And then there's the quants. This is hedge funds, this is quant programs, rules-based, but the E-mini net positioning, this is for S&P 500 futures. This essentially is where a lot of hedge funds sort of interact as far as adding or subtracting market exposure, whether it's they just want the market exposure or if they're hedging a position. Nonetheless, after this sell-off, people became really bearish in the futures market. They stayed really bearish through all of this recovery. But in the last couple of weeks, they've either been jumping back into the market or they've been closing out their hedge positions. either way, that provides upward movement to the market, which is why, if you're wondering in the last few weeks, in the last June, why the market kept marching higher when we kept getting sort of bad news, this is why. This is a big contributing factor. That the flows coming back into the market have been pretty substantial. So how are we positioned going forward? We are, we've been a little bit cautious, and even during this recovery and going into the bear market, so which helped us quite a bit. We clearly should have gone overweight at the end of March. Didn't, or sorry, early March. But nonetheless, we are underweight equity marginally. We have a mild underweight with about 50, for our balanced mandate of about 55% equity versus our benchmark of 60%. And the fact is, we just don't buy the V-shaped recovery. We think a lot of the harder work is ahead, and I think we think that's going to cause a lot more market volatility, potential opportunities. So we are mild underweight in equities, 55 versus 60, so not a huge bet against the market, but certainly a little bit more cautious. And we are holding excess cash, and we believe that is to be sort of opportunistic. One of the things that we think could be trouble for the markets is earnings season. We're about to start Q2 earnings season. This is going to be a very interesting earnings season. Let me tell you, in most cases, companies provide guidance. It gives analysts sort of an idea of where the baseline should be, and then they sort of tweak their models one way or the other. 80% of the S&P 500 companies have pulled guidance this year, which means they're not providing any forward looking because they just can't see. I mean, they don't know when the social distancing is going to let up, so they can't really have a very granular view on how things are going to look. So what it's caused is this really big disparity in estimates for Q2. And as you can see in this chart on the bottom right, the standard deviation of analyst expectations for Q2 has never been higher. In other words, the variation between high and low is very wide right now. People just don't know how it's going to sort of play out. I think that's going to cause people to be surprised in Q2 earnings season, which starts in about a week's time in mid-July. We trimmed our U.S. exposure marginally. Our problem with the U.S., and the U.S. has been a fantastic market, but the fact is, we have seen this really high concentration in the U.S. market. The top 5 companies in the S&P 500 now represent over 20% of the index. That's huge. If you're thinking, oh, well, we saw this in the 90s as well when technology had its bubble. The fact is, in the 90s, yeah, we had a tech bubble. But the fact is, the 5 top names in the S&P 500 back then were GE. It had some tech names, Cisco, but it had other names. It had Exxon, it had J&J. Today, the top 5 names in the S&P 500 are essentially Microsoft. You've got Google in there, or Alphabet. And it's never been this concentrated, and they're all tech names. It's Facebook, it's Amazon. Okay, so maybe Amazon isn't a tech name; it's super discretionary, but nonetheless, it's very concentrated in just one sector primarily, which we do believe is an added risk. So we have trimmed our U.S. exposure slightly. Still, only 1.5 points, so it's not a huge bet against the U.S. market, but we're certainly a little bit more cautious at this point. And on the emerging market side, we're very cautious as well. This is Google mapping of retail and recreational mobility searches and the like. And what we're seeing is that, yes, Europe's coming back, the U.S. is coming back, but emerging markets very slow. And again, that's primarily because their economies are being especially hard hit by this pandemic, and that has us pretty negative on emerging markets at this point. We still are constructive throughout the rest of the year. We just do think we are in an added risk of sort of another pullback in the coming months, which is why we have a bit extra cash and also a little bit of an underweight equity. And with that, I'll conclude it. If you have any questions, feel free to reach out to us and or to your advisor. And hope you enjoyed, and have a nice day.